gold has accomplished from this last leg of the rally. It's been a historical move to multiple all-time record highs and closes. Nicely, it kind of unfolded. In other words, recently we had what I'm calling a near parabolic move. In other words, we had almost a straight linear line up to Friday's intraday high just above $2,700. I am labeling major support at about $2,610, and resistance is just above $2,700. And that, of course, is based on the high that came in last week. In the case of right now, it would be Thursday's intraday high and Friday's move.
Gold has recently made a historic rally, reaching multiple all-time highs and setting new records. The latest surge has been described as nearly parabolic, with prices rising almost in a straight line to an intraday high of just over $2,700. Key support is noted around $2,610, while resistance is just above $2,700, based on last week's peak. Thursday's intraday high and Friday's movement highlight this trend. The well-known speaker Gary Wagner, a seasoned technical analyst and expert in precious metals, particularly gold and silver, exposes gold has recently climbed from approximately $2,400 to $2,700, indicating the completion of a primary third wave according to Elliott Wave theory. Analysts are now examining potential corrections, with the first Fibonacci retracement level at about $2,635, 23.6%, and a deeper pullback possibility down to $2,590, 38.2%. Gold may stabilize between these two levels. Gary Wagner tells if gold bottoms around $2,590, it would then enter a final fifth wave. This surge has propelled gold close to the $2,000 mark, a significant psychological level for traders. In Elliott Wave theory, the fifth wave often mirrors the price movement of the first wave. A deeper correction to $2,590 would likely push gold back up to approximately $2,723, concluding the impulse phase. Before we share clips from Gary's interview, don't forget to subscribe and turn on notifications. Only 10% of viewers are subscribed, and we need your support to hit our goal. Subscribe now and enjoy the video.
What we do is we measure the distance gold move from the bottom or end of this correction up to the recent top, what we are labeling as a primary third wave. And so we moved from roughly, call it $2,400 up to $2,700. And then we look at different levels that it could correct to. And what we're doing is looking at a Fibonacci retracement, and the shallowest retracement would be a 23.6, and that would take gold down to $2,635. A deeper correction would be a 38.2% extension, taking gold just below 2,600 to 2,590. The reason that I believe it will be a shallow correction is the typical model in Elliott Wave. There's a 5-wave sequence called the impulse phase, in which waves 1, 3, and 5 move in the primary trend direction, which of course has been up, and waves 2 and 4 are corrective waves. And on a corrective wave, we look for one to be an extremely deep correction beyond a 61% retracement, and the other one to be a shallow correction. And so when we look at this wave 1, which took gold from roughly 2360 up to 2530, the correction itself came in just below the 78% retracement. And that's what this line here represents. And you do have some wicks that come in there, meaning the tails or the intraday low. And so if we've had a deep correction, the most plausible model would suggest a more shallow correction. So if we are correct and gold truly corrects from here rather than it being a one and done, or in the case of current analysis, two and done, because we had a sell-off on Friday and follow through today, we could see gold trade as low as $2,635 and as low as $2,590. From there, we would go into a final fifth wave. And in Elliott Wave modeling, one of the simplest formulas to follow for a fifth wave is that wave 1 and wave 5 have the same price move. In other words, if wave 1 was a gain of $200, we would expect the gain of the fifth wave to be $200. So that's all I'm doing, is basically modeling the price move here and extending it. If gold has topped, corrects to a shallow 23.6% retracement, we would see gold go to 2635 and then move back up to a top of about $2,765. If it is a deeper correction to $2,590, we would expect the fifth wave to have the same price move in terms of distance, but only reach just above 2,700 at 2,723, 2,725. And that would conclude the impulse phase.
During an interview with Jeffrey Safran, Gary Wagner explains when gold rises alongside a strong dollar, it can sometimes overcome that strength. There's a direct correlation between the dollar's movement and gold prices, since gold is paired with the dollar, meaning they are always 100% linked. Gary Wagner highlights, if the dollar holds at current levels, we can assess technical areas to predict potential rallies or corrections. Fundamentals will drive the dollar's movement, but technical levels provide clues on where it might settle. The first target is around 101.70, and if the dollar strengthens, it could rise to 102 or even 104. Every point of movement, like from 100 to 101, represents a 1% gain in value against a basket of currencies, with the euro being the largest component. There's also speculation the Fed may cut rates by up to 50 basis points before the year's end. Gary Wagner exposes that continued rate cuts by the Federal Reserve are expected to boost gold. Currently, it's anticipated that the Fed will cut rates by 25 basis points at each of the final 2 FOMC meetings this year. However, depending on new data, they could opt for larger cuts, such as 50 basis points, to stimulate the economy. Fed Chair Powell emphasized that recent cuts aim to strengthen an already strong economy rather than prevent a recession. Overall, a total 1% reduction in the Fed funds rate is likely by year-end. Let's get back to the interview.
The price of gold is that sometimes when gold runs to the upside with dollar strength, it has the ability to overcome that strength. There is a 100% correlation between dollar strength or weakness and gold moving higher or lower, because we pair gold against the dollar. So obviously there has to be a direct 100% correlation. If the dollar holds in this area, we're going to look at different areas it could go for technical levels, because the fundamentals will drive the dollar higher or lower, but technical levels will give us an indication of where that rally or correction could conclude. So the first thing is we look at these tops. They came in at around 101.70. That would be the first area. The second area, and this is under the scenario that the dollar is going to get stronger, it's going to gain value against the basket of currencies that the index is paired against, we would look for a move possibly as high as 102 or even 104. Now realize every percentage point up, or every move up, meaning from 100 to 101, represents a full percentage point of gained value if the dollar is getting stronger, or of value that has kind of come out of the dollar as it relates to this basket that contains 6 or 7 currencies, but the euro being the highest weight of that basket. Absolutely continued rate cuts by the Federal Reserve will provide bullish tailwinds for gold, unquestionably. Right now, the anticipation is that during the final 2 FOMC meetings of the year, each meeting they will announce a rate cut of a smaller 25 basis points. Now, anything is possible. And as new data and reports come in, the Federal Reserve will use that and pivot from maybe a 25 basis points cut to a 0.5% if they deem that that's the best action to stimulate the economy. One interesting facet of what Powell said this morning is that the jumbo 50 basis point rate cut was not done to stave off a recession, but he put a different spin on it. He said, rather, it's to take a strong economy and make it stronger. In other words, he doesn't want it perceived that the Federal Reserve is enacting these steps to stave off something, but rather than to support something good in the economy. And I thought that that was interesting.
Yeah.
But I think most likely we will see a total of 1% come off of Fed funds rate, with a 50 basis point cut already enacted and two more 25 basis point cuts at the last two meetings in November and December.
Gold's recent rally to record highs, driven by both technical and fundamental factors, highlights its resilience even against dollar strength. As the Federal Reserve continues rate cuts, gold's outlook remains bullish, with potential corrections expected before a final fifth wave pushes prices higher. Investors are closely watching both dollar movements and Fed policies to gauge future trends in the gold market. How do you think the upcoming Federal Reserve rate cuts will impact gold prices in the short term? What role do you believe technical levels like Fibonacci retracements play in predicting gold's next move? Let us know in the comments section below. Also, ensure you like this video, subscribe to the channel first and then watch the video, and turn on post notifications for more videos like this. Until next time.